Hello, everyone. Welcome to the fifth lecture of Management 202. So in this lecture, we're going to finish the last part of cost of capital, which is to combine the existing parts that we have already been very familiar with in the previous discussions and lectures. So let's take a look. All right, so like I explained in the first lecture of cost of capital, right? So the essential goal of us is to calculate something that's called a weighted average cost of capital, right? So this represents the overall cost of capital for a firm, right? And we have talked about the assumptions of, whether it is a good method to use the WACC as an estimate for a project cost of capital or a project discount rate, right? And we're also going to mention a little more detail about that assumption in this slides. But if this is our goal, right? If this is our goal, then pretty much what we need to pin down is the cost of equity, right, for a firm, and the weight of the equity, right, in terms of its overall financing, and also the cost of debt for a firm, and adjusted by 1 minus the tax rate because of its tax benefits, right, and also the fraction of the overall debt financing of the firm, right. So this is the expression or the formula we're going to use to calculate WACC. And in this slide, we're going to show you how to estimate this WACC, right? And how to put all different pieces together for an estimate of WACC, right? And we're going to see some problems which will take a little bit more than 1, 2 steps, so that we can be more comfortable in thinking about how to estimate the overall cost of capital. Right. So we will talk about how to interpret, right, the structure of WACC, right. We will talk about what number we should use to find the weights, right, and we will also talk about different ways to find the cost of equity and the cost of debt, right. And in here we have one more complication added into WACC formula, right, meaning that for equity part, we're going to have two different kinds of equity, right? Preferred equity and common equity. And we're going to talk about the difference between these two types of equity, and also the models, right? We're going to use to apply to the estimation for each part of the equity. Right? So we're going to see a slight change in the overall cost of capital formula because of two different types of equity, right? Preferred and common shares, right? Preferred and common equity. Right? So hopefully at the end, right, by doing some examples, we'll be more familiar with, how to find the final answer. Okay. Okay. So about understanding the structure of WACC, right? This is something on top of our, existing discussion on WACC, right? That I want to explain. Right. So when you look at a firm, right, no matter a public firm or a private firm, right, the firm's value or the firm's ownings, right, or can be described in an asset table, right? So it will list all the type of assets that a firm owns, right? For example, its land, right, its factory, its equipment, right? And also there are certain type of assets which is sort of tangible, which is sort of intangible, right? For example, um, think about the amount of money that the firm is expecting to receive from its customers, right? So receivables, right? And there are also some type of assets which are related to the, maybe patents, right? Which is related to the company's reputation, and so on and so forth, right? All different kind of assets in one table, right? Representing what the company owns, right? And part of the assets may come from the company's own money. However, maybe a large fraction of the assets come from the fact that the company has financed money from outside, right? So if the company has borrowed from outside investors, then there is a part of the debt that the company is liable to pay back its investors, right? And if the company after the company, right, have spent the money or the amount of value deducted from the total value of the assets, then the remaining part is basically what is owned by the owners of the company, right? And this part is what we call equity, right? So equity is purely owned by the owners of the company, right? So for the equity part, we're going to talk about preferred equity and common equity, right? So preferred equity can be thought of as, a sort of a mixture of debt and equity, right? So it looks like it is defined as equity, but the functions of preferred equity is more similar with a bond, actually, right? So in short, preferred equity guarantees the investors sort of a fixed rate of dividend each period, and it will be paid after the bondholders, but before the common equity owners. Okay, so that's what preferred equity is, right? So if you think about that, right, it's actually not quite like a common equity, right? It's more like a bond, right, which entitles the investors a fixed payment every period, right, and also with a value which the bond owners will have, right? And so similar with bond, preferred equity can be called back, right, by the company, meaning that if the company think they have enough money, right, then it can basically pay back the financing from the outside preferred equity issuers, right? Preferred equity investors, right? To pay back their money, right? Using a redemption value, which is sort of similar with the face value of the bond, right? That when the bond matures, needs to be paid back, right? In the end. So here, right? So a lot of times when we talk about the value of a company, we will kind of use the word capital, right? So here, capital basically refers to the overall sources of a firm's financing, right? So think about debt investors and equity investors, right? They are basically the two major sources for a firm's financing, right? You either raise money from borrowing from outside, or you raise money from using your owner's own money, right? So think about equity owners, right, or equity investors as the owners of the company, right? So to compute a company's overall cost of capital, right, we need to think from these two sides, right, from the debt owner side and from also the equity owner side. And sometimes for equity owners, right, we want to think of preferred equity owners and common equity owners. Then if you think through this ways, right? So basically WACC, right, can be think of in this case, right, in terms of a balance sheet, right, can be thought of as the average or the weighted average of cost of debt and two types of cost of equity. And also this is how we calculate the weights for different parts, right? And the only difference here is that on a balance sheet, right, whatever you see for the value of assets, right, or for the value of debts and equity are what we call book value. Okay, so book value basically means this is the value that comes up from the estimation of the company itself. Okay, so it's a purely subjective valuation from the company itself. Right? It is informative to the outsiders, but also it wants to inform the outsiders that it is subject to change based on the real market scenario, right? Based on the real market value of the company, right? So for example, like what we have talked about, right? So a company's equipment will go through depreciation, right? So it will depreciate into its value over time. But the way we account for the depreciation, right, is purely a decision which is up to the company itself, right? So when you see a depreciation of $1 million in the year of in the first year, right, it doesn't mean that necessarily the company is able to sell that equipment $1 million less than the original price, right, at the end of the first year, right? It simply means that, this is the way that the company wants to discount or want to depreciate, right, the value for its equipment on the book, right? So that investors will know. This is basically the difference between book value and market value, right? So to calculate the actual weights for different parts, right, for cost of equity and for cost of debt, right, we want to actually use the market value instead of a book value, right? Because this discount rate should be assigned by investors in the market, not by the firm itself, right? When at the time of financing money, right? So because if you want to get money from other investors, right, outside the company, then you should use the market rate, right, instead of your book rate in estimating these values, right? So that's another point that we'll talk about later on. Okay. All right, so here is basically what we have seen, right, from the equation, right, from the WACC formula, right? For here, I want to mention a word called leverage. Okay, so leverage basically means, the fact that a company financed from debt, right, financing through debt, right? So a levered firm basically means that the firm has leverage, right, meaning that the firm has raised money by issuing debt, right? So these three expressions are purely equivalent, right? And an unlevered firm pretty much means that the company raised all its financings using its own money, right? Using only equity or using only the money owned by the investors, right? By the equity investors or by the owners of the companies. Right? So an unlevered firm means basically zero debt, right? A levered firm means the firm actually has borrowed from outside. So here, if a company does not have any debt, right, then simply WACC can be expressed just using the cost of equity, right? If there's no debt, so equity will consist 100% of the total financing. Then overall cost of capital will just be equal to cost of equity, right? For a lever firm, right? For a lever firm, right, then we need to use the formula that we have seen in the previous slides. Okay, so let's take a look at an example, right? So assuming the expected return on target equity is 11.5%, right? And the firm has a yield to maturity on its debt of 6%, right? So this pretty much tells you the cost of equity and cost of debt, right? And also it tells you that debt accounts for 18% of the overall financing, right? While equity accounts for the rest, 82%. If its tax rate is 35%, right? What's the estimate of this firm's WACC? Right? So feel free to pause a second here and take a look at the WACC formula for levered firm like Target right here, right? So try to plug in the numbers and see what you will find. Right. So if I'm going to do this question myself, here's basically what I will do. Right. So the WACC, right, or cost of equity will be equal to cost of capital will be equal to cost of equity times fraction of equity, right, plus the effective cost of debt times the fraction of debt. Right. So meaning it's equal to 11.5%, right, times 82%, which is the fraction of equity, right, 0.82 plus 0.06 times 1 minus the tax rate, right, times 18%, right? So the overall cost of equity is, so the overall cost of capital for Target here will be 10%. Okay, then the weighted average cost of capital, right, for this formula, we have talked about, right, in the previous two lectures on how to get cost of equity and also how to get cost of debt, right? But we haven't really talked about where the fraction of firm value comes from, right? So how do we determine the weights for equity and for debt? Right. So again, right, we want to use its market value, which is the value assigned from its investors, right? It's the numbers from the real transactions rather than the numbers on the balance sheet represented by book values. Right? So here is just one thing that we want to understand, right? So do not directly borrow the numbers from the financial statement. Rather, we want to actually see the numbers in the overall market, right? So let me show you where we can find the numbers, right? The actual numbers for a company's market value of equity and market value of debt. Right? So we can actually go to Yahoo Finance, who gave us a lot of information on companies, right? So let's search for a public company which has debt, right? So let's try Tesla. Okay, so here is the page for the stock of Tesla, right? Recently, the return, right, in the last week is not very handsome compared with some other stocks, right? So here, let's see what we can see in the summary, right, of the company, right? The summary information. It tells you some trading information, right? The stock price, right, and trading volume, right? On the other side, it will tell you other relationship, other information on its equity. Right? So what we can find, one thing here is called market cap, right? So market cap is a short for market capitalization, right? Market capitalization. And market capitalization is calculated as the number of shares outstanding multiplied by the stock price. So $752.188 billion here is the product of 793.53 and its number of shares outstanding. Okay, and so but here basically this market cap represents the market value of its equity, right? So this is pretty easy to understand. So where do we find the value for its debt? So here, actually I switched from the summary page to the statistics page, right? So we were here looking at its market cap, and if you click on statistics, it will show you on the numbers from its financial statements, right? So here we will see, about under the balance sheet, right? Under the balance sheet, we can see there's a total debt of 15.16 billion. Okay, a total debt of 15.16 billion, right? And we can use this number as an estimate for the market value of its debt. Right. So you might want to ask a question, right? So Mike, you just said that we want to use market value, right, instead of book value, which is from the financial statements, right? So why are we looking at this cost of debt, right? Why are we looking at the weight for cost of debt on a financial statement, right, which is the balance sheet, right? So here the reason is that on the balance sheet, right? Yes, this is a record of total debt, right, from the last quarter, right, which is likely change over the period of time. And also it is a book value, right? Although it records or it tries to record the total liabilities or total debt, right, using a number, right? So the answer is that, well, for equity, there's likely to be a problem because the value of equity changes a lot, right, over time. However, the total amount of debt is, or the price of a corporate bond issued by Tesla is unlikely to change quite a lot, right? So for Tesla, it might be a special case for Tesla because there was a period of time, right, in 2016, around 2016, I think, when the company has a large financial distress, meaning that there's a high likelihood that a company is going to go into a bankruptcy. Right? At that point of time, there is actually a large price change in the debt or in the corporate bond issued by Tesla. However, right, so recently, I think Tesla is out of the financial distress, so that its total debt is rated a higher rating by the rating agencies. meaning that the company debt value should not be changing very volatile in the recent period, right? So in this way, the book value, right, can be used as an estimate, right? The book value of the total debt from the last quarter can be used as sort of an estimate for its market debt of its corporate bond right now, right? So if you really want to get the timely market value of the company's debt, right, the company's total debt, then one way to do it is to sum up, right, the total market value of all its debt outstanding, right? All its corporate bonds outstanding. Right? So that's the other way to do it, right? However, you can consider this one as a similar number with what we can get using the market value of the corporate bonds. So this is just an easier way to do the estimation. Okay. All right, let's go back to our PowerPoint. Right, so we talked about where to find the value for the company's equity and also the value for company's debt. Right, so here let's take a look at this example. Right, so suppose Kenai Corp, right, has a debt with a face value of $10 million. Okay, so that's the only debt that this company has issued, right, with the face value of $10 million, trading at 95% of its par. Right. So if you don't know what that means, it means that actually the price of the bond, right, that is currently existing in the market is actually 95% of its face value. Right. So remember when we talk about bond, we mentioned the meaning of par. Right. So it means that the market value, right, the book value of the bond is $10 million. However, the market value of the bond is actually 95% of 10 million, which is $9.5 million, right? $9.5 million. It also has a book value of a book equity, right, of 10 million, right, which is what we can find in the balance sheet, right? The book equity, meaning the book value of the market equity, right? The book value of the equity is $10 million. And 1 million shares of common stock trading at $30 per share. Right? What weights should Kenai use in calculating its WACC? Right. So we just mentioned about the bond, right? We're trying to use a market value. So with the face value of $10 million trading at 95% of its par, the market value should be $10.5 million. So how should we find the weight or the value, the market value for its equity? Right? So for equity, book value is $10 million. However, the equity is currently traded, right, at 1 million share, with each share worth of $30 per share. Right. So we should have a market value of the equity equal to 1 million multiplied with $30. Right? So the market value of equity should total $30, while the market value for the debt should total $9.5 million. Right? So when we know the market value of each part, we can find its weight. Right? We can find its weight by dividing the market value of debt by the total amount of financing. And for equity, it's the equity value of debt, equity value divided by the total financing, right, which is 75.9%. Right. So actually, if you do one part, right, you can just easily calculate the other part by using 1 minus, cost of debt, right? So 1 minus the fraction of debt, right? So after you find the debt, fraction is 24.1%, right? 1 minus that is just 75.9%. Okay, so we've talked about how to calculate the market value, right, which will give us the weights for the cost of capital formula. Here, I want to go into some further detail on equity, right, which is about two different kinds of equity that you will frequently see in the market. Right? So they are called common equity and preferred equity. Right. So common equity, right? They are different in several ways, right? So here, before we jump into the detail, right? Think about preferred equity as something that's similar with a bond, okay, which gives you fixed payments and has a relatively stable redemption value or has a relatively stable price. Okay, so common equity is basically the type of stock that we always see in the markets, right? It it's very volatile, right, in terms of pricing. It gives a lower cash flow right, than preferred equity, meaning that investors in common equity are ranked after the investors in preferred equity in terms of receiving the residual cash flows of a company, right? So let's say the company made an earning and is determining who or how the money should be returned to its owners, right? Both preferred equity investors and common equity investors are owners of the company. Well, preferred equity investors will receive the cash flow before common equity, right? Before common equity, and also an important difference between common equity and preferred equity is about the voting rights, right? So common equity investors will have the vote, will have the right to vote on a company decisions, right? So each time the company wants to make a major decision, it needs to call a shareholder meeting where it gathers all the opinions, right? The opinions of all the shareholders, right? Sometimes it doesn't matter so much for a retail investor or for a small shareholder to vote or not to vote in the meeting because the company is majorly controlled by one or very few investors, right, who make the decision, most decisions for the companies. However, as an investor, as an investor for common equity, right, one will always get the notice, right, for attending the shareholder meeting and to vote on certain company decisions. For preferred equity, right, the investors have a higher residual cash flow, right, ranked higher than common equity investors. It has more of a fixed payment, right, as a dividends, right, and it will be received before the common equity investors, and most of the time it has no voting right or less voting right than common equity investors. Okay, meaning that regarding the decisions that's going to be made by the company, preferred equity investors normally do not have a say of how the company is going to do, right? So similar with bondholders, right, who just are entitled with the coupons and face and the principal payments, right, but do not get to say what the company can or cannot do. Right. So about finally, right, there's a price associated also, right, with preferred equity, right? The price, similar with bond, does not change a lot, right? And there's also this redemption value associated with preferred equity, meaning that companies who issued preferred shares often also has the right to buy it back, right, if it wants, right? So investors will have to tender in their preferred shares when the company makes such decisions, right? And before issuing preferred equity, right, the companies will make a decision, right? Will tell the investors that this is the redemption value of the preferred equity, which is which is basically the price the company will buy them back, right? So that's called redemption value. So very similar with the bond, right, for preferred equity, right? So it does not, in the sense that it does not often carry voting right, right? Preferred equity is more similar with debt, right? With debt rather than the equity, right? So the issue that arise from these differences between these two types of equity is that we might want to use different models to estimate the risk, right? To estimate the risk of these two type of equity, right? And you know, um, in return, we will likely need to use different models to estimate the cost of capital for different part of equity, right? So for common equity, right, as we discussed in the previous lecture, CAPM may make more sense, right, which accounts for the time varying risk, right, associated with equity, right? However, for preferred equity, right, it can be thought more as, a perpetuity, right? A perpetuity which pays constant or sometimes growing dividends. And if you hold that and does not return it, or does not sell it, or the company never buys it back, you can think of it as a perpetuity, right? You can think of it as a perpetuity or a growing perpetuity, right? So if in this case, a constant dividend um, growth model, right? A constant dividend growth model, or CDGM, is probably a better model, right, for calculating it. So I think we have done some examples on calculating a stock price using using CDGM, right? So we will also see some practice later in the slides. So for cost of common equity, right, this is basically how we get the estimates for equity cost of capital or cost of equity, right, using the CAPM formula. Cost of equity should be equal to or expected, right, cost of equity or expected stock return should be equal to the risk-free rate plus beta, right, which is the risk loading for this equity, right, times the expected market risk premium, right, using an estimate for the market return and also risk-free rate. So here again, risk-free rate are often represented by the treasury bills rate, right? So treasury bills, treasury notes in the short term. And we typically use SP 500 as a proxy for market portfolio. And beta is calculated using the covariance divided by the variance, right? So in terms of the horizon, right, for basically the sample period for the data that we use to calculate beta, a lot of times, right, for at least for Yahoo Finance, right, they use a 5-year horizon of monthly returns, right? 5-year horizon of monthly returns, which is less of a concern for the noises contained in the stock prices, right? So you are free to use the same way to make the estimation. Right? I think in the example that we showed in the last slide, we used daily returns to estimate beta, right? Which could be very noisy, right? So I think the recommendation is to use a monthly returns over the past 5 years, meaning that you will have 60 observations to estimate the beta. Okay, and the way the beta is estimated is pretty much how we do a linear regression, right? You regress the stock's risk premium on market risk premium over the previous 5 years, and the beta will be the slope of this regression, linear regression, representing the relationship between A, which is the risk premium of stock returns, and B, which is the risk premium of the market portfolio. So here's another source, right, on top of Yahoo Finance that you can find data on risk-free rate and on market returns. Okay, so in some more detail, right, the market return is a value-weighted return of all stocks listed in the 3 stock exchanges, right, in the 3 exchanges, which include more a variety of stocks, which is considered a little bit better than SP 500, right? But it correlates very strongly with SP 500. So for us, using SP 500 is already a very good proxy for the market portfolio. And for the estimation of the case report, right? So you can get data from anywhere, similar with Yahoo Finance, right? And you need to compute the stock returns yourself using the formula over here, right? So the price in the next period minus the price at this period, right? Basically the sell price less buy price divided by the buy price. So we can have an alternative way, right, for estimating cost of equity, right? Even for estimating cost of common equity, right? So there are certain stocks which actually does pay a very regular dividend on its common equity, right? So we can use this constant dividend growth model, or sometimes called Gordon growth model, also to calculate the cost of common equity for certain stocks like Coca-Cola, like those cash cows company whose business is very stable and the cash flows are very stable and certain, right? So I will not spend more time on this slide, right? But pretty much, right? If you think about the price, right? If you think about the price of the stock as the amount of dividend divided by the discount rate at this circumstances, which will just be the cost of equity, right, for its discount rate, less the growth rate, a constant growth rate of G, right? Then if you flip this equation over, then you will see that R of E less G will be dividend divided by P, right? So R of E will be dividend divided by P plus the G, right? Plus the growth rate, right? So here, cost of equity in this case can be thought of as the ratio between dividend and price, and plus the constant growth rate, right? So we can get the price of the stock, right, from the stock market, right, which is P0. We can learn about the amount of dividend that the company is issuing from its past announcements, right? And we can sort of have an estimation for the growth in its dividend in our mind, or either learn from the company's announcement. Right? So here, there might be some uncertainty on G, right? Because first, it depends on how the company is doing itself, right? And second, it depends on how investors are interpreting the company's future performance or forecasting the company's future performance, right? So G here could be a constant rate, but sometimes could also be changing, right, over time. If the market is doing well, G might be higher. If the market is not doing well, G might be lower, right? So there's a certain amount of uncertainty in the estimation of G. And here is the discussion between the benefit and cost of CAPM and CDGM, right? So for a capital asset pricing model, we will need to use the input of the beta, which we estimate from the historical data, right? And we also need an assumption for our risk-free rate, and we need an assumption for our market risk premium, right, in the future. And the correctness of CAPM relies heavily on the estimation of beta, right? Whether it is correctly estimated or accurately estimated to forecast or to describe the risk of the current firm's equity is very important, right? On the other side, for CDGM, right, we need to input the current stock price, expected dividends, and also we want to have assumption for its growth rate, right? The growth rate in the CDGM will be a quite crucial number determining the accuracy of our estimates of cost of equity. Okay. So here, we want to, I think the conclusion here is that we want to use CAPM, right, as a standard model for estimating cost of common equity, right, for cost of common equity. And then for preferred equity, we want to use a constant dividend growth model, right? And I will show you how we're gonna, apply that in the real example. Okay, so here, assume the equity beta for Johnson & Johnson is 0.55, right? There's an example on J&J. So the yield on 10-year treasuries is 3%. Okay, so the number is likely lower as of now, right? So this is a problem maybe 2 years ago. And our estimate of the market risk premium, right? So carefully here, it's risk premium rather than market risk return, right? Rather than market return, right? So here, 6% is already the difference between market return and the risk-free rate, okay? So furthermore, J&J is to pay out dividend at an annual rate of 2.81 at the end of the year, right? Its current stock price also tells you that is $92, and you expect it to increase at a constant rate of 4%, right, per year. Okay, you expect the dividends to increase. Okay, so try to forecast JJ's cost of equity using both the CAPM and CDGM model, right? So here you need to know that we'll need different inputs for different models, right? So for CAPM, we need beta, we need risk-free rate, we need the market risk premium to estimate the cost of equity, right? And for CDGM, right, we need dividend, right? We need the growth rate, and we also need the current stock price for estimation, right? So here's basically how we're going to do it, right? So CAPM will be something around 6.3%, while CDGM gives us another estimate, which is around 7.1%, right? So it really depends on how our understanding or how we interpret the function or the business from J&J, right? So if we think that is closer to some company that pays quite constantly growing dividends, then we should probably prefer a number closer to the estimate of CDGM, right? So if we do not have that assumption and just treat JJ's equity as a common equity that follows the CAPM rules, right? Then its estimation should be closer to 6.3%, right? So this is basically up to us in determining where the cost of capital is, right? And the good thing about using both models is that it gives us a sort of like a range, right? It gives us a range for our cost of capital estimation, right? So if these two estimates are very far from each other, it probably means that we need to make a decision on what the company's equity risk is like. Right? So it probably means that it's not a company that we can use CDGM with, or it is a company that's very close to a CDGM company. However, we should not use the CAPM model on, right? So if these two numbers are similar, like currently, then we're sort of comfortable that its cost of capital is around maybe 6 to 7%, right? It's not off by much. But let's say we get 10% from CAPM, and we get 2% from CDGM, then it means that something is probably off in our assumptions when using these two models, right? Which we better be careful with, right? Okay, so for estimating cost of preferred equity, right, we're going to apply the CDGM formula, right, which is to think of the preferred equity as a perpetuity, right? As a perpetuity, because essentially it's more similar with the perpetuity that pays constant or constantly growing cash flows to the infinity, right? To the infinity. So here, the cost of preferred shares will be equal to dividend divided by the current price, right? If there's no growth rate. But if there is growth rate, then we will add a G at the end of this formula, right? So here's an example which requires us to combine the cost of common equity and cost of preferred equity, right? So in this example, it says that this company, right, has this amount of preferred shares and this amount of common shares, right? So these are basically the data for shares outstanding. Right? A preferred share has a stock price of 50. Right, dividend of 5, and it will grow at a constant rate of 3%. Right, so with this formula, we can calculate the cost of preferred shares, right, using CDGM. Right, then it tells you that its common stock also has a share price, and at the same time it has a market beta of 3. Right, and we also know the market return. We also know the risk-free rate. then we can actually estimate the cost of common equity, right? So this is what we do. Right? This is what we do. We first calculate the cost of common equity, right? Well, cost of common equity. Oh, okay. So in this case, right, we'll calculate the cost of preferred equity using CDGM, which gives us 13%, right? And we calculate the weight for the preferred shares as the market value of preferred shares divided by the total equity value, right? Which is preferred plus common equity, right? So how do we determine the market value for preferred shares? Right? We do not directly know its total value, but we know the number of shares outstanding. We know its current price, right? So essentially, their product is the market value of preferred shares, right? And then we divide it by the total value of preferred shares and common shares, which is $5 million, 5 million shares times $60 per share, right? So the weight for preferred shares is 14.29%, right? 14.29%. So here, one thing I want you guys to keep in mind is that you would want to round this number to at least 2 digits after the after the decimal, right? Because if you just run it up to 14.2, then the final answer might be very different from what the number you should have if you have rounded more digits. Okay, so rounding here will be a problem, right? I know some of you guys have been taking points off because rounding in the existing homework, right? So one thing you should keep in mind is that you want to round to at least 2 digits behind the decimals for this part, okay? Just in case, right? The final numbers is slightly off, right? Or is largely off because of rounding. Okay, so similar, right? We estimate cost of a common equity, which is the R of comp here, right? So using CAPM, right? Risk-free rate plus beta times risk premium of the market portfolio, which is 9%, right? So in the real world, right, we should expect to see a higher cost of common equity than cost of preferred equity, right? So this is like a fake example, right? So the purpose is to practice the use of the formula. Okay, so we will have the weight for the common shares, which can be directly calculated using 1 minus the 14.29%, right, from the part of preferred equity, right, which will be 85.71%. Right? And then the overall cost of equity will be a weighted average of these two, which is 13%, which is the cost of preferred equity times weight of the preferred equity, right, which is 14%, plus cost of common equity times the weight for common equity, right? And then overall cost of equity will be 9.57% in this case, right? 9.57%. Okay, so about cost of debt, right? So what we mentioned, as we mentioned before, right? We want to use the yield to maturity as an estimation for cost of debt, and then it should be adjusted by 1 minus the tax rate because of the tax benefit, right? So here, if we have if a company has 2 types of equity, then essentially we want to rewrite the formula into something like this, right? So the overall cost of equity, the overall cost of capital should be equal to the weighted average of 3 things, right? Weighted average 3 things, right? So first thing, cost of common equity, right? So here I use R of E to represent cost of common equity, or you can change this R of E as R of comp, right? So it's clear, it's more clear to you. And cost of preferred equity, right? And cost of debt, right? Cost of effective debt, right? So, and when there's no preferred equity, right? So it's basically these 2 parts participating in this formula, right? And then we want to plug in the WACC, right, into the denominator of our net present value estimation as the discount rate to discount future cash flows, right? So this is eventually how we will arrive at the estimate for net present value. Right? Okay, so let's take a look at an example that talks about the calculation of the cost of capital for a company that involves all three elements, right? All three elements in financing. So here a company has, similarly with the last one, right? All the same information with the last one, right? So additionally, the information is if the market return is expected to be 5, interest rate of 10, right? So the first paragraph is the same with the last question, right? So in addition, the company will have $50 million of corporate bonds that offers a yield to maturity of 7%, right? The tax rate is 40%, right? What's the weighted average cost of capital, right, for the entire firm, right? For the entire firm, right? So there are two ways to do it, okay? So the first way to do it is that if you want to use the second formula, So if you want to use this, okay, so if you want to use the second formula here, right, then you probably want to calculate the overall cost of equity first, right? And the second way is that if you don't care about the overall cost of equity, then you can basically just use the first formula to calculate the weights of each part and also the cost of capital for each part. Okay, so I recommend using the first way. Right? I recommend using the first way. So the way you do it is that you calculate the weights and cost of capital for each part, right? For each part. So in the quiz, right, you will see this question in homework, right? But in the quiz, right, we will break the question apart into different parts, right? And you're responsible for calculating, each part, right, one by one step. Okay. So don't worry that I will not give you, such a long question, right? Just for one question, but you are likely to get, different parts of the questions, broken into different questions, right? So it won't be too much calculation within one question, okay? So if we want to use this formula that consists 3 parts of it, right, then we want to fix the weights for each part and also the cost of capital for each part, right? So the weight, right, the cost of capital for preferred shares and common shares are already calculated, right, from the last example. However, the weight will change because now we have to consider additional debt, right? So the weight for preferred shares will be market value of preferred shares divided by the market value of all 3 parts, right? So it will be outstanding shares, right? Shares outstanding times the price for the preferred shares divided by the total value, right? The total value of all 3 parts, right? So you can calculate this number first, right? By adding the total value of the three parts together, which will give you $400 million, right? So the weight for preferred shares over here, or this preferred percent, right, will be 12.5%, right? Similarly, for common equity, you will have 75%, and debt will give you another 12.5% as the total weight, right? So in the end, the formula we will arrive at will be 13%, which is cost of preferred shares, times the weight for preferred shares, right, plus cost of common shares times weight of common shares plus cost of debt, right, times 1 minus tax rate times the weight for cost of debt, right, which will be altogether, which will be 8.9%, 8.9%. So this is the calculation of the overall cost of capital for a company that have financed through these 3 ways, right? I find it through the 3 ways. Okay, so to summarize, right? To summarize, for a question that asks you how to calculate the cost of capital for a firm, right? First of all, we want to determine how many parts are involved in the company's financing, right? We want to determine its financing sources and also their weights, right? So let's get the weights done first, right? Because by calculating the weights, we are going to sum up the total amount of financing of all the parts that are involved, right? And second, we want to calculate, right, the cost of capital for each type of financing, right? Sometimes if we think about the cost of debt, we want to calculate the cost of the effective cost of debt, right? Or you can leave the calculation of effective cost of debt in the final formula, right? So number three, we want to put different pieces together and compute the overall weighted average of all costs, right? So this is another example, right? This is another example which talks about, well, sorry, my PPT is having a lag right now. I don't know why. Okay, so this is an example that requires the knowledge of both capital budgeting, right, in the first topic, and also the knowledge of cost of capital estimation in the topic that we have just talked about, right? So a food manufacturer is thinking about building a new snack brand, right? The project expects to an initial capital expenditure of 40 million, right? So this is capex, right? Incremental cash flow of $10 million. These are cash flows, right? From year one, which will constantly grow at 5% for 5 years, and after which it will be terminated, right? So the company has a market capitalization of $50 million, and outstanding debt of $20 million, right? Cost of equity is 10%, while current yield to maturity of the debt is 6%, right? Corporate tax is 35%, right? Should the company take the project, right? This sounds like a pretty complicated example, right? So let's take a look in the Excel, right, and see how we can do it. Okay, so let's start with showing the cash flows of this company, right? So we start from year 0, 1, and it lasts for 5 years, 4 or 5, right? And we'll terminate after 5 years, right? So we will have a cash flow of -10. Oh, sorry, we'll have a cash flow of -40 in the beginning, an incremental cash flow of $10 million in year 1, which will constantly grows at 5%. So this cell should be this number times 1 plus 0.5, right? 1 plus 0.5. And then we want to copy this along the way up to here. Okay, so this is our cash flows, right? This is our cash flows. So we will also have, we will also need to calculate the cost of capital, right? Cost of capital here should equal to WACC, right? Cost of capital here should equal to cost of equity, which is 10% times the weight for the equity, which is 50 divided by 50 plus 20, right? Plus cost of debt, which is 6%, times 1 minus tax rate, which is 35, times weight of debt, right, which is 70 divided by 20 plus 50, right, the total financing. So this should be our cost of capital, or the discount rate that we use, right? So here we will calculate net present value as the rate, which is this rate, and these numbers, right? And then divide amount, and let's see the, okay, so this is a positive number, right? So we should, this give us a positive number, right? Meaning that we should, subtract 40, right? Subtract 40 from this from this year 1 to year 5's cash flows, right? Because 40 is what we see at year 0, right? And it gives us a positive number, right? It gives us a positive number. So this one is net present value, right? Give us a positive number, meaning that we should take the project, right? So we should take the project, right? So if you want to calculate it using a calculator, this is where you would go, right? So this calculate the WACC first, calculate the net present value next, right? And determine if we should take it by the sign of net present value. Okay, so as a final word, right, for calculating cost of capital, we make certain assumptions, right? So we first assume that project risk equals firm risk, right? Remember, this is the first assumption that we talked about, right? And we talked about the case when how we want to think about the discount rate that we're going to use for a project, which could be, a bit different from the company's overall cost of capital, right? So in that case, we probably want to use the cost of capital from a firm that purely invests in one type of projects, right, as the alternative discount rate. And then we talk about constant leverage and financial distress as the other two assumptions for estimation WACC, right, as the discount rate. Right, so regarding a company that has different divisions, right? So if you really want to find the overall cost of capital for that company, you can actually calculate a discount rate or a WACC for each of its division, right? And then use the weighted average of all these WACCs together as the overall cost of capital, right? Right, so here's an example that you can take a look at, right? When thinking about whether we would want to use the company's own cost of capital or some other company's cost of capital as an estimate for the discount rate of the project. Right, so in the end, we want to think about cost of capital as a discount rate, right? Meaning that companies are risky, right? And investors will bear this risk for investing in these companies, so they should apply that as a discount rate when they make investment decisions, right? And on the other side, it is very costly to finance this money, right? To finance this money for projects, right? And there are, excuse me. And we will going to talk about the ways that companies connect with the financial market, right? To raise the money or to raise the funding for investment, right? So how do companies, basically asking the question, right? How do companies really get money from investors' pockets, right? So how do company issue debts, right? And how do company come up with what terms should be added on a contract of its bond, right? So how would company do IPOs, right? How would company raise external financing when company is still a private company, not a public listed company, right? So we will talk about all these rules and all this process or the important steps in the process for companies to raise money from outside investors, right? Through either debt or equity, right? And this will be our next topic, which is called external financing, right? And we'll also talk about the issues that's involved in the steps of raising money from outside, right? And hopefully we can also talk about some topics regarding the conflicts between different investors, right? For example, between debt owners and equity owners, right? Or between the manager and other equity owners, right? Or between the manager and the debt owners, right? Themselves. Okay, so this concludes the this slide and also this recording, right? And also the topic of cost of capital, right? So in the live session, we're going to do some more practice on estimating cost of capital as a discount rate for a firm project. Okay. All right. Bye bye.